Thank you very much. I'm still full of ideas and good thoughts from the two previous presentations. We now go to the ECB, and I've not chosen this very provocative title, and I would underline the question mark, because we'll see what the conclusion will be. You hear? Yeah?
Yeah, there's my...
Yeah, okay. So I would like to structure the presentation in three parts. First of all, to see what was in the treaties, then what happened to the architecture under the stress, and then to look a little bit at the new roles that the ECB either has taken or has been assigned more recently, and then analyze that in the perspective of whether it is or not a fiscal policy making institution. I start with the first point. I will go very quickly, of course, because I'm sure you all are very aware of it, but I would like simply to discard at the outset some concepts that you find very often mentioned, meaning that when Maastricht was drafted, there was no idea that crisis could come, and everybody thought everything was fine, and you know, it was a happy period, and so on and so forth. It is indeed true. When the euro was introduced, we had, well, almost 10 years of sunny weather, let's say. But at the time of drafting the treaty, it was, I mean, we had the exit from the European monetary systems. We had quite stormy times before, and it was very clear that these risks were there. So just very briefly, if we look at what was introduced in the EMU, in Maastricht, and then basically confirmed and reinforced a little bit, but only very mildly modified by Lisbon, it was a structure in two parts. Monetary policy was an exclusive competence conferred at the European level to the ECB directly. So exclusive competence was not mentioned in Maastricht, was then clarified in Lisbon, and there was no voice in the doctrine, even in between, that doubted that this was indeed an exclusive competence. On the other hand, coordination of national economic policies, coordination was a very laudatory word, because what was there under coordination before Lisbon has reinforced a little bit the position of the Commission, but before it was exchanges, coordination, information, but really no cooperation, no coordination in the sense of let's try to plan together, not at all. So to be very frank, this was national policies on which there was a little bit of exchange. As I said, Lisbon has reinforced it a little bit, but not very substantially. Now, apart from this, there was also the issue of fiscal policies. So it is not correct, as I say, that people were only thinking of sunny weather. It was clear from the outset that fiscal policy is the part of the economic policy that risks of having or indeed has an impact on monetary policy. Monetary policy cannot completely be separated from economic policy, because what you do in fiscal policy, the stability of the finances of the government, will have an impact on how the market runs, etc., and this will have an impact on what the ECB then will have to do. So it was clear that there was a risk there, and this is why certain measures were put in place from the beginning. Now, I just have on the right side the actors, again, to underline ECB, exclusive competence, clearly European institution, coordination, Commission, light coordination, member states. Fiscal policies, you will see that it was Commission and ECB in the preparatory monitoring trying to part, the Council in trying to, again, coordinate remedy, I'm saying in the measures that were put in place. But in fact, what it is not written, because it's part of the economic policy, the main actors are still the member states. We should also not forget that fiscal policy is one of the very few areas in which you still need unanimity. And this was not changed. This was discussed in the Constitution, in Lisbon, etc. But there is no interest of the states to give up their veto rights. So if we look at which were, here I have a problem, but let's try to read it. Which were these rules that were trying to contain this fiscal problem issue? They are basically the rules that later on were then reinforced in the Stability and Growth Pact. So these are all the rules that talk about the, well, first of all, at the entrance in the euro area, you have to pass a test, and this test is contained in the two convergence report of the Commission and of the ECB, and two of the four criteria plus the legal that you could count as a fifth, but two of them, which is not meaningless, are first of all the sustainability of the government financial position, and second, the durability of convergence reflected in long-term interest rates. So these two elements clearly are showing that if you're not there, you should not enter monetary union. So this link was there. This is preventive and corrective. This is what I was saying before, is the excessive deficit procedure, which was then reinforced in the, completed by the protocol, by the regulation. The Stability and Growth Pact was introduced, was later a little bit weakened. The prohibition of monetary financing, the no privileged access rule and no bailout clause, these three key rules are the ones that basically say member states should not finance themselves in ways that are not correct or straightforward. Yeah? So these are prohibitions that have two purposes. One, to preserve the independence of the central bank, because normally all these things were done by putting pressure on the central bank to finance the state. And second, to avoid that the state simply spends too much and therefore jeopardizes its economic position. So this is simply to say it was clear that this was a risky area. It was clear that going forward for monetary union, this is unique. First monetary union and only thereafter the idea of economic union and perhaps political union. Monetary union normally is the end of this process. It has been decided, as we all know, for political reasons to achieve this at least and thereafter follow with the rest, but it was clear to everybody that in between there was a risk. And these are the rules that were put in place. They did not function, that is true. They did not function properly, but it is incorrect to say it was not thought of. So if we go to what has happened, and again I go relatively quickly because I think you know all of this, but we know, everybody talks about it, we can divide the crisis in two parts. The first part is what we call the banking financial crisis. Now in this part, there were no big doubts about the activities of the ECB. The ECB was actually praised a lot all over the world, a lot in the States, for example, but also in Europe. It was very clear that we have been better than the Bank of England, better than the Fed, that the ECB could react more flexibly to the market needs, etc. What did the ECB do? The ECB acted using its tool of monetary policy. And it could limit itself to do that because at the time the crisis was a banking and financial crisis. The needs were liquidity needs. The problems were the market could not properly function because the liquidity was not circulating. So what did the ECB do? This is a little bit the list that you can find if you consult the web of the ECB, much more extensive listed there. But the idea was to try to avoid that the situation would be worsened by the lack of liquidity. And there are always these chain effects in the markets that are caused by the lack of liquidity. So first of all, the key interest rate was lower very, very quickly, down to 1% about in 2010. We are lower today. The main refinancing operations that are regularly 3 months long were prolonged to, I'm looking at the other now, the LTRO. Long-term refinancing operations that are normally 3 months long were prolonged up to a year. The main refinancing operations were also changed. These are the operations that are the most regular monetary policy instruments. Normally it is like a tender where the bank, until then, the bank asks who needs money, and then the rate will be established according to the best offer, more or less. Yeah? Now it was said, no, we don't need this. We need to give as much as people need. We will set the rate. But we give, the quantity is not limited. And this is what we mean by full allotment, fixed rate. This has started then and is still continuing. We also started to give liquidity in currencies of third countries. Now this is completely unheard of. Giving the currency of someone else is a task that no central bank ever allowed before, because this is an expression of sovereignty. Giving out liquidity is really part of the public authority. So every central bank will give its own currencies, and then every commercial bank will have to use its own branches of or subsidiaries in the other country to get that particular currency if they needed it. Now what we did is a number of agreements with the Fed, with the Bank of Japan, the Swiss central banks and other central banks to get the possibility. We had certain swaps among each other that they issue euro and we issue dollars and all the other things. Why? Well, because a lot of the commercial contracts need these currencies, and also because there is a difference in the time zone. So it can happen that when they need the money and they have to close the contract now, the other bank is closed. And then this could create an insolvency. So this was quite an important measure. We then started purchasing cover bonds in euro, and then we also broadened the collateral framework. In Europe, there was no really shortage of collateral initially because the collateral that the central bank would accept to give out liquidity was pretty broad. Nevertheless, with this credit crunch, it became a bit tight, and so we broadened that as well. So these are all monetary policy instruments, all, however, new instruments. In that sense, the ECB showed a little bit what Bruno was referring to as the creativity of the lawyers. In this case, was probably lawyers and operation people inventing new ways to go out. Then started the second phase of the sovereign debt crisis, which proved to be much more complex. And this is, it was not anymore a liquidity issue only, but in fact the market fragmented itself completely. Today, this is what we are facing. So first of all, the ECB continued with the previous conventional measures that I've listed and even making it more generous. So for example, long-term refinancing operations, we've now issued a couple of times up to 3 years. Up to 3 years, meaning that we allow people to give it back before if they don't need it anymore, but this is a very, very long term, of course. And also we broadened further the collateral. But then we started also with one measure that was quite criticized as perhaps being a little bit at the borderline of monetary policy, the securities market program. The securities market program has a clear legal basis. This is Article 18 of our statute, which is an article that is a legal basis for monetary policy operations. I've quoted here, I don't know if you can read it, it's a bit small, but in italics is two recitals that justify why, even though the legal basis is monetary policy operation, there are some features that are pretty novel. And so first of all, it is mentioned that there are exceptional circumstances, severe tensions, and they hamper the monetary policy transmission mechanism, and therefore we cannot anymore operate our monetary policy. And then the second that I wanted to point out is that the ECB takes note that the member states have stated that they will take all the measures needed to meet the fiscal targets. So the second is a little bit more of a reminder to them, you've committed, so we do our share, but remember you have committed. So it's not a condition, but in a way it's a good reminder. The first, perhaps I need to explain it a little bit better because it's maybe not so obvious to people who don't work in central banking. What was happening? What is still happening? The market doesn't move. The market is completely blocked. We assist to a renationalization of the capital markets. First of all, the banks do not trust each other, so they don't lend to each other. The normal banking market is stopped. Second, there is a difference country to country because we know that there are different interest rates. And then the question that often comes is why on earth, if the ECB has the same interest rates, there are different interest rates in the different countries? Why there are these differences in not only in the bond rates, but also in the lending rates of the commercial banks? Now, a very simplified explanation is that, of course, the different interest in the bond rate is determined by the risk factor that is attached to that particular country. Of course, someone who invests in a country where they fear I might not get it back because that country is so financially unsound that at some point might tell me, look, I only pay back half, will want to get a higher interest rate. This is pretty obvious, I think. But why does this have an impact on the normal lending rate? The easy explanation I was saying is the commercial bank finds themselves facing a choice. Do I invest in public bonds, which give me a certain interest which is pretty high and relatively sure, or do I lend to a private who also has a risk, because I also don't know if that person will pay me back, and then what do I ask for a rate? And then there is a cost and an opportunity cost to be valued, and of course then that particular commercial bank in that particular state will never ask for less than what it would get if it would invest in state bonds. So this is how, in a way, the market has, first of all, stopped itself. Second, in reality, some commercial banks don't lend to privates or to undertakings anymore because they don't want to be told the ECB is giving a certain rate and you ask me 4 times as much, and so how is it? And you are then challenged for what you're asking, so they simply prefer not to offer this money. So these are a little bit simplified explanations, but it puts you a little bit in front of the situation we're facing. Now, before the crisis, the ECB was very, very successful in doing what we call the fine-tuning operation, so intervention on the market in order to regulate the rates, only once a week. While in the Bank of England or Fed, they have to intervene several times a day. That showed that our rates were matching quite well what was going on in the market. Today, we don't do so much anymore, well, apart from the fact we are so low anyway, but the effect of what we do is completely minimal. So the reality is there is no transmission. This is what I was meaning by, or our rules are meaning by when they say the monetary policy transmission mechanism. The main instrument of a central bank is through the amendment and the change in the interest rates to have an impact on the economy, to have an impact on how much money is distributed. This does not really happen because this transmission mechanism doesn't function. So in that situation, the issue for the ECB is, do we simply take this as a fact? The treaty simply told us you use monetary policy traditional interest, you simply say, I'm incapable of doing anything? Or do we try, like the treaty normally tells the institution, you have to achieve the objectives? Do we have another instrument that could unblock the situation? This was precisely what we tried to do here. So the idea was, if we try to clean a little bit the market or absorb a little bit of these bonds that were blocking the market, some mobility will start, some dynamics will function again, and our mechanism will start again. So this was a little bit simplified, the idea behind this. But it's simply to say it was really motivated by a monetary policy reason. Now, this was I took a little bit of time, but I think it's so different, perhaps, that technical that maybe needs a bit of explanation. This measure was very controversial. You might remember 2 members of the Governing Council, one, the German governor and the German member of the board, resigned last year, basically for disagreement on these measures. Since then, the present German governor makes public his dissenting opinion whenever he has the possibility. So every morning or every other day you see that he does not agree with this type of action. But we decide by majority, so he's in minority, but we have changed from the previous practice that it was a collegial decision and we would not manifest externally the dissenting opinions. This has been challenged in court. In 2011, the German Constitutional Court declared one action inadmissible, but we are waiting now in another action, which is actually brought against the ESM. The court, in a first decision on the intermediary measures, urgency measures, has said that the question whether this is a measure ultra vires cannot be examined in that context, but will be examined later. So we are now expecting a decision. Is certainly not this year, and we will see what the German Constitutional Court will say. But the reasoning is what I tried to explain before. This was a necessary instrument to achieve the objective of monetary policy, which is price stability, which we can only achieve if our tools function. So my conclusion here was, did the ECB go beyond its attributed competencies? And maybe I should, it has gone below the slide, but there is a no at the end of it. It's a bit hidden, but it's there. So I'll take up a couple of other new roles. So the SMP was something that the ECB itself decided to do and which was considered to be borderline and perhaps doubtful. Now there are a couple of things that I would like to mention where the ECB has been given some tasks. And the first I would like to mention is the missions. Now, to go on missions is not a normal task for a national central bank. No other central bank, to my knowledge, does it. If they do it together with the state when the IMF comes on the other side of the table, when they ask for money. So this is very special, and we are not the IMF, we are a central bank. What has happened is in 2010, the European Council said that the Commission should monitor the implementation of these measures together in liaison with the ECB. And this is how the Troika was created. This is the first time, the word Troika did not exist, of course, but this is the first time this tripartite composition mission, ECB, Commission, and IMF, went to Greece, and then they started going a little bit more in other places as well. So this visit was from 21st April to 3rd of May, and thereafter, more missions took place. Now, the issue here is what is the role of the ECB in these missions? Now, I would like to go through quite quickly, so I will not stop on these slides, but just to show you, in the six-pack, there are several provisions, I've only mentioned some, that talk about the participation of the ECB in surveillance missions and enhanced surveillance missions. There are different qualities, etc. The ECB is always there. If you read the text, just have a look at the underlying part, together with the Commission. In fact, the Commission is there, and it can do it, it can invite representatives of the ECB, and it does it in liaison with the ECB. So the main actor is the Commission, supported by the ECB. The ECB is not the one to which this legislation gives the task. Two-pack is a little bit the same. I've also quoted some things. You will see constantly acting in liaison, in liaison, in liaison, in liaison. This is always in liaison. This is for the review mission of the two-pack proposals. In the ESM, a little bit the same. So the recital talks about the possibility to request the ECB to perform certain tasks, but when you go to the text, is again the Commission to negotiate in liaison with the ECB. And the same in Article 13 of the ESM, which is a long article. This is the one on negotiating the financial assistance. The ECB participates in negotiating the MOU, which is the one where the conditionality is decided. But, again, is the Commission in liaison with the ECB and eventually the IMF. It's not the ECB. Same in these other articles where you see the assessment is the Commission in liaison with the ECB, etc., etc. So why do I quote all this? How is the ECB involved in these missions? All these texts indicate two concerns from my perspective. The first is to ensure that the ECB is not the decision maker. It is very clear to the European treaty drafters or policy makers that the ECB is a technical body, that there is an issue of accountability, that it cannot take this type of decisions, and it is a technical advisor. So why is it in? Well, it's very clear. There is an expertise at the ECB that you don't find, to be honest, at the Commission. The Commission has a certain part of what we discuss in the mission, but there is another part, and in particular when you talk of recapitalization of credit institutions and this type of things, that the ECB is much more competent. All the part that is linked in particular to macroprudential supervision, the ECB has, well, some resources that are not present in other institutions. The other concern that I think the treaty and legislators had was to allow the ECB to be part to avoid that, this is a little bit delicate and it is not written anywhere, but I'm pretty convinced that it is a reason and that it was considered, to avoid that the way out from a crisis is money creation through making the central bank pay. It would be easy to say we don't need to liquidate this institution, we can keep this institution alive, we can continue to give it liquidity, which after a certain time is not anymore liquidity, it becomes insolvency money in a way, to avoid the cost that could be linked to this. The IMF could be a little bit more vigilant, but in a way the IMF has an interest to finalize a crisis and get its money back. So the idea of having the ECB there, the ECB that has the long-term objective of price stability in mind, which is a very important good for the European citizen, makes this composition of the mission more balanced and takes all these perspectives into account. The second point is the protection of the independence of the ECB. So the way to write the text is also to allow the ECB not to take up a task in case this task would be cornering the ECB, for example, or trying to put pressure on the ECB, or in case the ECB would feel I would be in conflict of interest or I would be in conflict with the achievement of my main objective. So this is the preservation of the independence of the ECB. I'm very much try to speed up a little bit. So again, here, my answer about the missions would be no. The ECB, first of all, has not asked to do this, and I tell you, we also have quite a number of difficulties in catering for this, because this was not a task we were supposed to do, and it is bringing a lot of work. Plus, we are on the newspapers every day. Some of our staffs are attacked in those countries, so it's not particularly nice. People who want to work in a central bank are not generals, are not military, are not politicians, so they don't particularly like political conflict, so it's a bit complicated. So one other issue I will touch very briefly is emergency liquidity assistance. Emergency liquidity is a typical role of central bank, but it's such a secret role to avoid that people count on it, that is not written in, I think it's written in 2 statutes of central banks in the euro area, but in most it is not even written, but it is taken for granted. It is the lender of last resort role. The concept of emergency liquidity is to give liquidity not to a solvent but illiquid institution for a temporary period, to avoid, to bridge in a way the time until the liquidity will be back and the institution could continue. And it's always granted against collateral, but it's never collateral that is so good as it should be to get normal liquidity from the central bank or to get liquidity from the market, because otherwise, of course, this institution will go on the market. Now, this task is considered to be a national task with no loss sharing. Why? Because there is a high risk of loss. There is a judgment. Is this a liquidity need or is this an insolvent institution? There is a moment where it's very difficult to decide. The ones who decide are the national central banks, and they will then suffer the loss in case this has not been, in fact, a liquidity, but an insolvency issue. However, this national task can have an impact on monetary policy. Let's assume one central bank of one member state starts giving out a lot of liquidity of ELA. Of course, this has an impact on monetary policy. So there is a rule in Article 14.4 that the Governing Council can say you cannot do it because this would have a strong impact on monetary policy. Now, lately, during the crisis, this instrument has been used more generously, let's say, than in the past. And therefore, the central banks have come to the Governing Council to get these approvals quite regularly. It has been needed. So the issue is here always is not that you can say, no, you don't do it because we don't want to take the risk. The risk could be bigger if you don't give it. It could be the biggest institution of your country that has a GDP higher than the country itself. So it really is very, very critical. At the same time, and here again, I'm sorry, I must have had another format on my computer because I see you don't see the last line, but I wrote there, the ECB must be very careful to avoid that the broadening, you don't see. Anyway, that this decision, the broadening in time and in quantity does not then jeopardize monetary policy. Okay, so I had 2 more things, but one is, let me tell one brief thing, because you saw it on the newspaper. On the OMT, the outright monetary transaction has been announced, is being adopted, it will be published soon after adoption. It is a new program, again, on a legal basis, 18.1. Now, the difference with the SMT that we saw before is that now we have conditionality. So there are basically 3 conditions. The first is the Governing Council needs to see that monetary policy transmission is impaired, which is the case. The second is that the member state can receive it only after it has asked for help from the ESM or EFSF. So you don't come to us if you first don't ask for the other. And why is that? Because in that way, the state is really serious. The state, to get the loan, needs to commit to something. They normally like to come to us because it was a little bit easier. So we only give it if they have asked. Still, the Governing Council is free to decide whether or not to ask. So it could still say, I don't think it's necessary here. And it only gives it if the member state has or is regaining bond market access. So it is to help getting out of a situation. If there is no hope anymore, we will not do that. So this is a little bit the new scheme, and the question again is this fiscal policy making? Again, the answer is no, because first of all, it's a mean to the objective of re-establishing the possibility to do monetary policy. And then the other thing is that the conditionality is a link to the conditionality that has been set by the Commission. So it's not that we impose conditions, we only want them to comply to those conditions. We'll not talk of the banking union because you have it tomorrow, and I will conclude by saying why, if the ECB is not a fiscal policy making institution, why did it take up these roles? Which were the reasons? Well, the first I already mentioned, to pursue the objective we were given by the treaty. No other means would have had an effect utile. We can do as much as we want. If we don't do this, it doesn't function. And then there are two more reasons. The ECB has one primary objective, price stability, but it has a secondary objective, which is to support the general economic policies of the Union, provided you don't jeopardize price stability. But it is in the treaty. So, of course, we need to support, as far as we can, the other policy. And now financial stability, and to restore viability also for the Union and the country's fiscal situation is an objective of the Union. And finally, to comply with the obligation of loyal cooperation with the other institutions. To go to mission is to support the Commission upon request of the Council. So that is the situation. I would not say this is taking up fiscal responsibility, and I will finish. I'm sorry for... I was late though.
Yeah, yes, absolutely.
Thank you.
Thank you very much.